Hey everyone, welcome back to Corporate Decoder, the place where we break down all the confusing corporate jargon for you. Get ready because Lionsgate Studios Corp is back with their proxy statement, and it is packed with some juicy details that give us a real look under the hood of what has been going on. Before we dive in, if you love getting these kinds of unfiltered insights into company reports, make sure you hit that subscribe button and join our Discord community, linked in the description below. We're building an awesome group there to talk all things business and investing. Today we are dissecting the Lionsgate Studios Corp proxy statement for their annual meeting. This isn't just a collection of corporate speak, it's a roadmap of their recent performance, their plans for the future, and even a peek at how much their top execs are making. We will sift through all the details to find out what really matters for the company and for us as investors. So let's get straight to it. Lionsgate held its annual general and special meeting where significant proposals were put forward. We are talking about electing directors, reappointing their accounting firm, and an important advisory vote on executive compensation. Think of this document as the company's report card and its plan for the next year. The company just had its annual meeting on the 17th of March of 2026. This is a key moment where shareholders get to weigh in on who will be leading the company and how it is being run. They are voting on electing 11 directors, a pretty significant number, which indicates a board that is actively engaged in the company's direction. Now let's talk about the folks running the show, the directors. The company is asking shareholders to elect 11 directors. This is a crucial part of corporate governance because directors are responsible for guiding the company's overall strategy and making sure management acts in the best interests of shareholders. We see a mix of directors with long tenures and some newer faces, which suggests a balance of experience and fresh perspectives on the board. For example, Michael T. Fries has been on the board since 2015, and his extensive experience from Liberty Global is a big asset. Now let's get to the part everyone is curious about: executive compensation. The company is clearly laying out how it pays its top brass. We see a mix of base salary, annual bonuses, and long-term incentive awards. The strategy here is to link pay to performance, which is a good sign. They use performance metrics like adjusted OIBDA, which stands for operating income before depreciation and amortization. They also looked at segment profit, which basically means the profit generated by each part of the business, like their film and television divisions. Let's dive into some of the numbers from the summary compensation table. For fiscal 2025, John Feldheimer, the Chief Executive Officer, had a total compensation of over $9.8 million. Michael Burns, the Vice Chair, also had a substantial package over $7.7 million. What is interesting is how much of this is tied to things like stock awards, which directly link their pay to the company's stock performance. This aligns their interests with shareholders, which is a generally positive practice. This section is really important because it shows how the pay of the top executives lines up with the company's actual financial performance. They're comparing the chief executive officer's pay and the average pay for other top executives with really key performance indicators. You can see the company's total shareholder return, which is how much money shareholders made the Dow Jones US Media Sector Index Total Shareholder Return and the S&P Movies and Entertainment Index Total Shareholder Return. They are also showing their net income, which has been negative for the last few years, which is a concern, and their adjusted OIBDA, which has been positive but fluctuating. For example, in 2025, the Chief Executive Officer's compensation was over $9.8 million, while the company's net income was a loss of over $362 million. However, their adjusted OIBDA was over $448 million. This shows that while net income was negative, the operational performance was still generating positive cash flow. This is a common story in media companies where you might have significant investment in content that impacts net income, but the underlying business operations are still strong. It is also worth noting their stock ownership guidelines for directors and executives. While they do not have strict requirements, they encourage ownership, which is a good way to align everyone's interests with the long-term success of the company. The idea is that if the executives and directors have their own money tied up in the company's stock, they will make decisions that benefit all shareholders. This section highlights any business dealings between the company and its directors or major shareholders. For instance, we see agreements with MHR Fund Management LLC and Liberty Global, which shows a concentration of influence in certain board appointments. This is quite common in companies that have gone through significant financial restructuring or have major investors. Mark H. Rachesky MD is a designee of MHR Fund Management, and Michael T. Fries is a designee of Liberty Global. This means these investors have a direct say in who represents them on the board, which can be both good for oversight and a potential concentration of power. The company spent almost $9.5 million on audit fees in 2025, which is a significant chunk of change, but not unusual for a company of Lionsgate's size. They also spent a good amount on tax planning and advisory services, over $3.1 million. This shows they are actively managing their tax strategies, which is an important part of financial health. Okay, let's tie this all together. Lionsgate Studios Corp has clearly been navigating a complex period with the separation of its studio and Starz businesses. The financials show a company that is operationally profitable with positive adjusted OIBDA, but also facing challenges with net income and dealing with the fallout from past impairments. The executive compensation is substantial and heavily weighted towards equity, which is a good sign for shareholder alignment. However, the reliance on specific large investors for board representation and the negative net income are points worth watching. The direction seems to be focused on leveraging its strong content library and franchises to drive future growth. So what is my take overall? Lionsgate is in a transitional phase. They are positioning themselves as a focused content studio, and their operational performance measured by adjusted OIBDA is solid. The risks lie in turning that operational profit into actual bottom line net income, something that has been a struggle given those impairments mentioned. The opportunities are in their vast library and successful franchises, which can be monetized across various platforms, including live entertainment. What do you guys think about these numbers and what they signal for Lionsgate's future? Drop your thoughts in the comments below. If you found this breakdown helpful, make sure you give this video a thumbs up and subscribe for more deep dives into corporate filings. And don't forget to join our Discord community, linked in the description, for even more discussions and insights. Thanks for watching, see you next time.